We hear constantly that the world's biggest tech companies are paying for the artificial intelligence boom straight out of their own endlessly deep pockets. But a look at their internal records shows a significant shift in how this expansion is actually being paid for. This chart maps the hyperscalers' capital expenditure against operating cash flow. The physical spending line crosses the generated cash line here in 2026. That cross-hatched area represents an annual shortfall over $700 billion. They must pivot toward external debt. This technological future is being built on top of a fragile, high-leverage foundation, the AI infrastructure debt complex. To understand how fragile this architecture is, we have to look past the weightless software and track where those borrowed dollars are actually going. This capital flows directly into the interstitial brownfield, aging local power grids, industrial cooling systems, and rapidly depreciating specialized silicon. Because tech companies are racing to secure physical capacity, they are using massive layers of off-balance sheet private credit to quietly hoard this infrastructure in the dark. They treat the physical earth like a blank theoretical spreadsheet. Centralized gatekeepers extract massive amounts of energy and raw materials from local communities, without any mechanism to measure if there is genuine human need for the output. If the promised revenue fails to materialize, the corporate losses will immediately spill over. The physical environment and the macroeconomic system itself are left completely exposed to the fallout. This diagram maps the AI ecosystem. In the top tiers, AI labs, infrastructure owners, and cloud providers form a dense network. Following the capital reveals circular finance. Suppliers send investment dollars downward to companies purchasing that equipment, pushing commercial contracts back up. These contracts create a mirage of guaranteed revenue. In reality, many of these multi-billion-dollar agreements contain clauses that let either party walk away with just 90 days' notice. By trading these soft contracts back and forth, the ecosystem creates a closed loop of speculative expectations, artificially inflating how much debt the entire industry can borrow. Because this debt is built on revenue generated by the exact same debt, a single major player failing to meet their obligations could collapse the entire illusion of value. This hierarchy diagram shows financial risk sliced vertically. Layer 1 is the physical base, single-tenant data centers and rapidly depreciating processors. In Layer 2, banks write loans against them. This packaged debt is pushed upward onto the balance sheets of insurers, pensions, and everyday people. This creates structural subordination. The complex packaging ensures that if the underlying assets lose value, the thinnest junior layers of capital absorb the entire shock first, instantly wiping out investors who believed their portfolios were completely safe. We have clear historical proof of what happens when massive debt meets speculative demand that fails to arrive. In the early 2000s, telecommunications companies issued $500 billion in bonds to lay thousands of miles of fiber optic cable. They anticipated a massive surge in internet traffic that took years to materialize, causing a catastrophic crash in market value. Today, the AI sector faces a similar winner-take-most dynamic. If a major AI lab stumbles or capabilities hit a wall, the hyperinflated collateral values supporting these financial structures will evaporate instantly. A financial failure at the top of the stack sends a violent shockwave downward. Credit dries up, local construction halts entirely, and the massive energy assets built to power them are left stranded. A correction in tech valuations will quickly trigger a macroeconomic freeze, paralyzing the physical supply chains and local communities trapped underneath the collapse. Simply tightening banking regulations doesn't address the scale of this problem. Because the current build-out is so deeply integrated into our pensions and physical power grids, we need a way to change how the capital flows at the source. We have to execute what researchers call a kinetic decoupling. This means deliberately untethering our actual technological capabilities from the speculative, highly leveraged debt traps carried over from the 20th century. We must transition to a system of prosperity co-creation. Capital and computing power should be routed exclusively to resolve verified capacity deprivations at the local level, instead of financing speculative projections of future demand. When we stop extracting resources to fuel financial illusions and start co-creating with the physical environment, we eliminate systemic risk, and ground the future of advanced computing in true human prosperity.